Which stocks should you sell after the GameStop short squeeze? Plenty of stocks benefited during the GameStop short squeeze soiree that occurred a little earlier, and those moves affected the market in general. At the same time, once investors came back down to earth and realized that these companies needed to actually provide value, which stocks will pull back a little bit. We'll take a look at what caused the run-up to the short squeeze, how it affected other stocks in the orbit of GameStop, and how other specific stocks that may have risen in general may actually also be overvalued and should be considered carefully, if not dumped altogether, if you own one or more of them. So be sure to hit that like button for the YouTube algorithm, and we'll get started. You're watching Finance Squared, and I'm your host, Derek West. On Finance Squared, we love talking about all things personal finance. And oftentimes, that means discussing the stock market and stocks to buy and stocks to sell. And it can mean looking over some things and incidents that fuel the prices of stocks, sometimes unjustifiably. After all, the stock market is a market composed of humans. Humans can be rational, and just as often, they can be irrational. And sometimes, while they're being rational at one thing, they can be irrational about other things. And during the short squeeze that recently occurred, rational actors forced up the price of various stocks because they felt that the stocks were undervalued. And some folks just wanted to stick it to institutional investors. This affected the market generally in a couple of different ways. Among those, a rise in the general market and a large sell-off soon thereafter. And this should cause investors to wonder if they have any other overvalued stocks in their portfolios. But before we get into that, let's take a look at what caused the short squeeze in the first place. The GameStop short squeeze is one of many market moving events that has the entire stock market moving and quaking at the moment. The run-up of some stocks has caused some stocks that were expected to be hard gainers to really have their value appreciated. Some of those companies are taking full advantage of the situation and raising capital off their newly minted positions. Take, for example, the Naked Group. Other folks are taking their newly found windfall and cashing in, knowing that once the dust settles, the value of their stock will likely not be held at inflated positions. See the three high-level executives of BlackBerry, who sold quite a bit of their positions, totaling $1.7 billion or thereabouts. In general, this whole short squeeze rebel alliance has gotten folks who are interested in the stock market to rethink and remember what a short squeeze is. Now, for those of you who don't know, shorting a stock is when an individual or institution, like a hedge fund, borrows a stock or quantity of stocks and sells them immediately with the expectation that the stock is not worth what it is currently trading at, and therefore will fall in value at some point in the near future or the distant future. The shorter will then buy that stock back at the new lower price, giving the stock back plus any interest for borrowing the stock. Well, a short squeeze occurs when that stock, instead of falling, rises in price, making the borrowers of the stock either buy it back at a loss or at the very least have enormous collateral in their margin accounts to ensure that they can buy it back when the loan of the stock is called. This can further get squeezed if someone is selling options to sell a certain quantity of stock at a certain price at any point in the future. As long as the price of the asset never approaches the out-of-sight price of the option, everyone is fine. But as it gets closer, the seller starts to buy quantities of the stock to hedge their bet. And as they buy more to hedge their bet, the price continues to run up. Other people and algorithms start to notice and buy as well. And the price continues to go up, becoming a self-fulfilling prophecy, which is effectively what happened with the GameStop short squeeze. Now, this short squeeze also affected other stock prices of other companies targeted by institutional investors. Stocks like the aforementioned BlackBerry, Fossil Group, Nokia, AMC Theaters, and other companies once left for dead by the average retail investor. This volume of trades executed on these short squeezed companies has investors of all kinds thinking about other stocks for other reasons and why their values might soon fall, and whether now is the appropriate time to take the profit of the stocks you are invested in and sell, or even short. The effect of this can be seen in the massive sell-off of the stocks in the major stock indices in the days following the infamous squeeze. Many companies which were doing not that bad at all had major sell-offs almost inexplicably, which has many people looking at the long-term outlook for the stock market in specific and the general economy in general. And now that the holiday season is over and the election madness is settled, what will the economy look like in 12 months, 14 months, 16 months? Will the market go into bear territory? Will it stick around with bull territory? Will the economy continue to expand? Will the economy contract? These are all questions and concerns that many investors have had, and it has been taking a toll on the stock of quite a few companies. And here are a few that really stand out. AirBnb. Now, why Airbnb, you may ask? Didn't they just have a successful IPO on December 10th? They sure did. Shouldn't the travel industry somewhat open up in 2021? Isn't the pandemic finally over? Well, the jury is still out on that one. I'm not sure if the travel industry will be any better at any time in the next 10 years with the way this pandemic is played out, to be honest with you. But that isn't the only reason why this stock may be one to avoid or even offload after its successful IPO. Another reason would be its negative shareholder equity. Now, what is shareholder equity? Shareholder equity? Well, shareholder equity is a quantity that shows the book value of an equity or its total assets minus total liabilities, which gives a rough estimate to any prospective investor what the company could be worth if it were to be liquidated, and if its assets were sold, and the liabilities were repaid, with all the proceeds going to the shareholders. Well, Airbnb shareholder equity is negative at around minus $520 million. And that's only reason number two. Another reason is that the large valuation is thought to be excessive. This is a common problem among celebrity stocks, as I like to call them, that goes back for decades and includes such luminaries as Apple, Amazon, even Facebook and Google. That being said, once their businesses really kicked into gear, their valuations look cheap in retrospect, which is really the risk you take when you invest in an IPO like Airbnb. But then again, there have been many companies where the bears were right. They really weren't worth the valuation that they received shortly during their post-IPO period. The stock price of Airbnb is around $183. The company has a market capitalization of $109 billion and revenue of $3.6 billion for the trailing 12 months. Meaning Airbnb is currently trading at 30 times its trailing 12-month revenue. Having only been public for less than 2 months, which is currently unprofitable, this valuation may be excessive, and the losses may not just be attributed to the pandemic either. In 2019, pre-pandemic, their losses were $674 million. The final question you should be asking yourself about Airbnb is the business model even workable, particularly in the United States? You see, the Airbnb business model is intuitive, yet unique simultaneously. And it and other similar companies have disrupted the hospitality industry across the globe, and for good reason, and in my personal opinion, for the better. I personally hate most hotels, as they're mostly very impersonal, and even the most luxurious ones you can tell were designed for scale and convenience. They're all mostly located in the same parts of town, depending on the luxuriousness of the hotel, and when you visit them, you never get a feel for how the natives really live. Now, when you get an Airbnb, you could be in any part of the city, and you really get a feeling for how the people in that neck of the woods are really living, and you get to experience a bit of their lifestyle as well, which is what I feel is one of the best parts of traveling, putting yourself in the shoes of others. That being said though, is the business model viable? There's a reason hotels are laid out the way that they are, and even if there is room to improve, is Airbnb the company to do it? It has several competitors, including many hotel chains that are nipping at its heels, and what it does is not particularly innovative either. Setting up a website that allows people to list their spaces for rent. At some point, the market will catch up with Airbnb. And at that time, will its stock be as valuable as it is today? Probably not. It's a good reason to consider dumping that stock. Just a thought. Next up, we have QuantumScape. I know a lot of people who are excited by the trends in the electric vehicle industry and in the technology that it promises to deliver. And QuantumScape seems to be in the right place at the right time to capitalize on the excitement. The company touches on many investing trends. This company and its stock is a pure play on electric vehicles and their disruptive technology offerings. And that's the most important thing about them, really. The technology that the company is developing are solid-state batteries that look to upend some of the pain points of electric vehicles currently. Most importantly, solid-state batteries offer up to 50% improvements in electric vehicle range, so it's easy for investors to see the attraction of this particular stock. But while there are plenty of reasons to be interested in the technology, there's a reason for investor skepticism as well. QuantumScape isn't going to have a battery ready for commercial production until 2024, with significant sales not anticipated until 2027. But is the technology even viable? I'm always skeptical of companies who have technology offerings that aren't proven to be viable at scale. That is to say, can they produce what they're claiming to produce at scale profitably? Company CEO Jagdeep Singh plainly admits that commercialization is very much not a foregone conclusion. And until those fears are squashed, I would say that this is a stock that you should avoid. And then we have FuelCell. FuelCell Energy is a top developer of hydrogen fuel systems, a type of renewable energy that, if powered by a technology like solar and wind, or nuclear, could be considered a clean technology. It's one of the many energy companies that promises to take the new revolution of green energy promised by the new administration into the future. The company's fourth quarter results were mixed. Its revenues were up 54% year over year at $17 million, with its sales up about 17% for all of 2020. It's a company that relies on contracts from the government and other large businesses for its revenues. For example, a 2.8 million megawatt biogas power platform in Tulare, California, an 8.8 megawatt power platform for the U.S. Navy in Groton, Connecticut, and also a 24.5 megawatt project in Yaphank, New York, and Derby, Connecticut. Those facilities were partially completed for Toyota. But as you can see, contracts for those sort of things are the drivers for the revenue of the company, but also things like grants from the Department of Energy to continue with its work, along with $156.3 million with a secondary offering of its shares. And of course, the long-term outlook for alternative energy does seem to be pretty good overall. But is FuelCell primed to be one of the companies to get us there? Or will it be among a list of companies who will be humbled by the realities of the market and the real world? Many people feel the stock is overvalued, and thus many are bearish on the stock in general. For example, JP Morgan's Paul Koster downgraded FuelCell stock to the equivalent of a sell rating, with a $10 price target for the stock anticipating a more than 50% drop from its current levels. And of course, no Wall Street analysts are perfect. They're human just like anybody else, and they don't have a crystal ball to tell the future. But that being said, FuelCell might be a company you want to sell now, while you will still get a reasonable price and profit from its value. And then there's the tale of NIO, the China-based electric vehicle maker. Many people feel that NIO could be an automaker that could, in fact, compete with Tesla for the hearts and minds of electric vehicle lovers. The company also happens to have enjoyed impressive growth numbers of its own. As a matter of fact, most people think that NIO still has plenty of room to grow and climb further, along with its sister soldier company, Tesla. The Chinese electric vehicle market, which is expected to be the largest in the world, is continuing to soar. In 2020, electric vehicle sales in China were at around 1 million, and that number is expected to grow to 6 million by 2025, with NIO leading the way in delivering vehicles to satisfy that demand. And being tied to the rise of the electric vehicle maker Tesla in the US, investors who are skeptical of Elon Musk's company or simply want to diversify in other electric vehicle plays see NIO as the top play to make. But every silver-lined cloud has a dark, mysterious center. Because the company is so closely tied to Tesla, if Tesla slips for whatever reason, NIO could pull back as well. Can NIO continue its current rate of growth of over 100%? Or will it rapidly slow down? Is its current market capitalization of nearly $100 billion, which gives it a higher valuation than General Motors? Is that cap a result of investors looking to diversify from other possibly overvalued stocks such as Tesla Motors? And are they hoping for a future delivery of vehicles that fulfill a demand of 6 million electric vehicles in China in 2025? By the way, GM sold and delivered 2.5 million cars and light trucks in 2020. Will electric vehicle sales outpace regular cars and light trucks by that much in 2025? Maybe, maybe not. And because of all these questions, NIO should be a stock that you should consider possibly offloading in the very near future. Speaking of events in the very near future, we have videos coming out about topics like stocks, such as NIO and Tesla in the very near future. So you're going to want to be in the mix when they drop. So to do that, be sure to subscribe to this channel and enable post notifications, because when you do, YouTube lets you know when our videos drop. And coming up in the very near future, we'll have videos on how to save so you can invest. We'll also be starting a series on how to start a $1 million business in about 12 months. So stay locked in so that you'll be there when we drop those videos. And remember, a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Be sure to take action on some stocks that may be overvalued in your portfolio. Perhaps think about offloading some of them, or maybe not. And I'll catch you next time. Peace.